And then in the 17th century BC, Hammurabi and the Babylonians invented this thing we now call insurance and the ability to transfer the financial consequences of risk to someone else was born. However, when we're focused to think about risk consciously, especially when it involves insurance, most of us are like, I don't want to think about that, or in fact, I'll think about anything but that. Or maybe I'll give you 15 minutes if you can save me 15%. Most of us spend a tremendous amount of time thinking about how to grow wealth, but few of us spend perhaps enough time thinking about how that wealth could suddenly disappear. A lawsuit, a cyber event, catastrophic loss, risk management and insurance are often some of the least discussed but most consequential decisions in the entire financial structure of a family. And this becomes even more important in family enterprises, which what we'll define today as family offices and large privately held family businesses. Because the risks in a family enterprise don't sit neatly in separate boxes. And what makes this even more challenging is that most enterprise risk management models fall short in this environment. They're designed for corporations where risks are evaluated within the boundaries of the business itself, and the family's risks are independently siloed. But in family enterprises, the family is part of the enterprise. And in essence, the family is the enterprise. Personal assets, governance decisions, and lifestyle risks can directly affect the broader organization. Given this interdependence, the family's risk management plan should align with the broader enterprise risk management structure and disciplines for the enterprise. And with that in mind, I think it's helpful to think about this through a traditional enterprise risk management framework, which generally organizes risks into four broad categories. Okay, so this part is a little dry, so just hang in there with me. First, in an enterprise risk management model is strategic risk, which represents the mission, foundation, governance, things like who has authority to make major financial decisions, are family members aligned on long-term objectives, is the next generation prepared to manage wealth responsibly. These are risks that threaten the long-term preservation of the family enterprise and are foundational to the success of generational wealth preservation. Next is financial risk. These are risks that generally affect the value, stability, or access the entity has to capital. It addresses how much liquid capital is available to support the enterprise if investment performance declines. How exposed is the portfolio to market volatility? How exposed is the enterprise to estate tax changes, et cetera? Okay, smooth sailing so far. So halfway there. Things really start to get interesting at the next level, which are operational risks, generally described as arising from failures in people, processes, or systems. And they are directly tied to the day-to-day functions of the enterprise. This includes things like cybersecurity, internal controls, vendor relationships, fraud and internal theft, privacy and data protection, business continuity. These all sit within this category, and operational risks, if realized, often create cascading effects that spread very quickly throughout the entire enterprise. And lastly, there are hazard risks, and these are what you would typically think of as traditional insurable risks. So things like property damage, liability, claims, lawsuits, auto accidents, and catastrophic events. So this particular ERM model leads to an insurance program that is designed to transfer specific risks from the enterprise to an insurer using commercial insurance tools. These include entity-specific property insurance, liability insurance, employment, E&O, D&O, cyber. These are commercial insurance policies written to protect the business entity. What these insurance policies generally do not do is extend coverage to the family members outside of those defined roles. The family's homes, personal activities, cyber exposures, personal staff, and lifestyle risks fall outside the scope of this typical commercial ERM framework. Because while the family and the enterprise are economically interconnected, the insurance policies protecting them are usually built in completely separate silos. To put this into context, think about a large corporation like Apple. At Apple, enterprise risk management is definitely a formal discipline. There are teams of people, hundreds of them, whose full-time job is to identify, measure, and manage risk across the entire company. Their job is to develop and support a risk framework, something similar that we just went through, that is entirely focused on the corporation. This framework does not attempt to manage the personal lives of the executives or its shareholders. Apple isn't concerned necessarily about Tim Cook's homeowners insurance policy, and they don't care if a board member allows her 16-year-old son to drive her cigarette boat. These personal risks squarely fall outside the corporate ERM model. In a public company like Apple, the shareholders and the enterprise are separate. The company manages its risks, and the shareholders manage their personal lives independently. In a family enterprise, those boundaries often don't exist. It's basically all the same. Family members often serve as owners, directors, executives, beneficiaries of the enterprise at the same time. Their personal activities, assets, and decisions can directly affect the broader organization. This is why we believe a fifth family risk layer should be included. Family risk refers to the exposures created by the personal lives, assets, and behaviors of the family members. This includes things like the residences across multiple states or countries, aircraft and watercraft ownership, domestic staff, philanthropy and board participation, and cyber habits. None of these risks typically fall within the traditional corporate ERM framework, and they are rarely covered by the enterprise's commercial insurance program. But they can still create real enterprise consequences, and the lifestyle of the family can become a risk vector for the enterprise itself. Which is why in a family office or family-owned business environment, effective risk management requires looking beyond the traditional corporate model and incorporating family risk and personal insurance into the broader framework. However, once we apply the family risk layer, another challenge quickly appears: the gray zone between personal and commercial insurance. In family enterprises, and particularly family offices, the lines between personal activity and enterprise activity are often blurred. This happens for several reasons, and I'll dive into three of those today. First is ownership structures are often complex. Homes, watercraft, investment entities may be owned through LLCs, trusts, partnerships. Determining whether an exposure belongs to the family or the enterprise is not always straightforward. Second, there are employment relationships that cross the personal and commercial boundary. Family offices often employ individuals who serve both personal and enterprise roles, like estate managers, personal assistants, household and operation staff, security personnel. These individuals may be paid by a family office entity, but their work may occur at personal residences or during personal activities. That creates important questions around exposures like workers' compensation, employment practices liability, and general liability coverage. Third, there is the issue of professional acts versus personal acts. When a family office professional makes an investment decision that may fall under professional liability or E&O coverage, but if that same activity involves personal capital, family members, or affiliated entities, it may fall outside of the defined scope of that commercial policy. Similarly, family members often serve as directors, trustees, officers across multiple entities, some commercial, some personal, some philanthropic. Determining which D&O or fiduciary policy responds in a claim can become very complex. These scenarios and others sit squarely in that gray zone between personal and commercial insurance. Now, to further illustrate these points, I'd like to walk you through some real-world examples to show how personal and commercial risk boundaries can blur, starting with cyber risk. In this case, the family office and the family household are operating in parallel systems. The family office handles accounting, investment management, and bill pay using corporate email and financial systems, which are protected by a commercial cyber policy. At the same time, family members communicate with staff through personal email like Gmail and personal devices like cell phones. The family member's household financial activity is being protected under a personal cyber policy through a high net worth insurance carrier. The problem occurs when a cyber criminal compromises a family member's personal account. This is a story that kind of is kind of told a lot these days. But the attacker impersonates a family member, sends instructions via email to the family office CFO requesting a large wire transfer for what appears to be a legitimate purpose. And then after receiving a fraudulent two-factor authentication text confirmation, the CFO releases the funds from a family office investment account. So the question becomes, was this a personal cyber event because the breach originated with the family member's account, or was it a commercial cyber event because the financial transaction occurred within the family office? Both insurers now have to determine whether their policy responds. And each may argue the loss falls outside the scope of their coverage. This is exactly the type of kind of gray zone exposure that emerges when personal and enterprise systems of a family are interconnected but viewed separately. Cyber attacks are a legitimate threat, especially with respect to family offices. These events are happening, and insurance companies are definitely paying claims for these types of losses. Next, I would like to highlight the gray area that shows up in governance and investment disputes within a family enterprise. In this example, the family office LLC is the insured entity. The chief investment officer and other leadership are considered insured persons under the policy. And at the same time, several family members sit on the investment committee, and a family trust is one of the investors. The issue arises when an investment recommended by the CIO fails after a few years. The family trust files a lawsuit against the CIO, family office, and the investment committee, alleging poor investment decisions. At that point, the insurance carrier may argue the insured versus insured exclusion applies. Because the entities involved, the family office, the trust, and the individuals, may all qualify as insureds under the policy. And the carrier may argue that the claim is essentially one insured suing another. This is why family office liability policies often require careful structuring, including specific coverage carve-backs that restore coverage when disputes arise between beneficiaries, trust, or other family-controlled entities. Specialist companies like Chubb Insurance offer products that address these types of unique family enterprise coverage needs. Final example I wanted to highlight is how ownership structure and insurance coverage can easily fall out of alignment. In this situation, an ultra high net worth family transfers a $15 million California home into a trust as part of their estate plan. But the homeowner insurance policy was never updated to reflect this ownership change. The individuals remain listed as the named insureds, while the trust, the actual legal owner of the property, is not listed on the policy. Then a catastrophic event occurs. In this case, a wildfire that results in a total loss of the home. During the claims process, the insurance company discovers that ownership of the property changed and is now held by the trust. At that point, the insurer may raise an insurable interest issue, arguing that the policy does not properly reflect the entity that owns the policy. We've actually seen this happen. After the Pacific Palisades fire in California 2 years ago, a Main Street company, this would be one that you would immediately recognize if I said their name, and I'm not going to say their name, had a significant concentration of total losses due to the wildfire. Our insurance carriers did as well. Within the first month after the fire, we heard that this Main Street insurance carrier was positioning to deny claims if the policy named insured did not exactly match the ownership of the home. Although this carrier seems to have ultimately done the right thing and appears to be honoring these claims, the problem is that it caused unnecessary delay with the claim settlement, which is exactly what you don't want in a situation like this. In a catastrophic event, speed definitely matters given the demand spike for labor, building materials, permits, etc. Okay, so now I'd like to pivot to discuss when you use insurance, how to do this in an efficient manner. But first, I feel it's important to talk a little bit about the broader insurance market to provide some context. So one of the most important forces affecting the insurance market today is the rapid increase in large-scale natural disaster events in the US and actually globally. Over the past decade, the number of billion-dollar weather events, which include wildfires, hurricanes, floods, and severe storms, has increased significantly. What used to be a relatively infrequent event are now occurring with much greater regularity. As a result, carriers are clearly facing increased underwriting pressure. They are becoming more selective about the risks they insure, more focused on documentation and upfront mitigation, and in almost all cases, increasing pricing. For ultra high net worth families, family offices, and privately held enterprises, This means that in order to find efficiency in the insurance market today, requires a much more thoughtful approach than it did even 10 years ago. Another major force adversely affecting the insurance market is reinsurance pricing. Reinsurance is essentially insurance for insurance companies. They purchase this to protect themselves from large catastrophic losses. Due to the increased frequency of catastrophic weather events that we just discussed, the cost of reinsurance has increased significantly. As reinsurance costs rise, insurance carriers flow these expense increases directly to their insureds. At the same time, reinsurers have pushed higher attachment points, which means insurers must now absorb more losses themselves before reinsurance kicks in. However, if you look to the far right of that graph, you can see the rate increases actually declining in 2024, and that has continued in 2025. So that's a bit of good news foreshadowed. Third factor adversely affecting the insurance market historically has been low interest rates. Property and casualty insurers generate earnings from two primary sources: underwriting results and investment income. So much so that insurance companies are the largest institutional holder of U.S. Treasuries and have historically been able to rely on investment income to offset weak or weaker underwriting results. But for much of the past 15 years, interest rates have been historically low, which significantly reduced the investment returns insurers can generate on their reserves, which then required them to more heavily rely on underwriting profitability. And then the final factor I'd like to touch on is inflation, particularly construction cost inflation. So property insurance ultimately pays to rebuild your physical assets. And the cost of rebuilding has increased significantly in recent years. Materials like lumber, copper, roofing, concrete, and labor have all experienced sustained pricing increases since COVID, and we've only recently seen these increases begin to plateau. So when you combine all this good news, the result has been fairly predictable. We're all paying more for our insurance. And over the past several years, we've all experienced premium increases, particularly in property and auto insurance. And at the same time, underwriting standards have become much tighter. Carriers are being more selective about the risks they insure, more focused on documentation and mitigation, and more willing to decline or restrict coverages when risks fall outside of their underwriting appetite. This has also created another result, and that's the growing role of the excess and surplus lines market, or E&S market. The E&S market has traditionally handled non-standard or difficult to place risks, but in recent years, it has moved much more into the mainstream. As standard carriers pull back from certain geographies, more risks are being placed into the surplus lines market, which provides insurers with greater flexibility in pricing, coverage terms, and underwriting. So what we're seeing today is not necessarily just a pricing cycle, but we believe it's a broader shift in how insurance markets are structuring and underwriting risk. Regarding where things are headed, there appears to be some sunshine on the horizon. Some of our carrier partners have told us their 2026 catastrophe reinsurance pricing has renewed at a decrease of 20%. and Pure Insurance, who is a major writer of high net worth homes in Florida, has announced a 7.6% rate decrease for homeowners insured in that state. AI is also having an impact, allowing insurance carriers to create more detailed loss models and use capital in different ways. So the days of double-digit pricing increases at renewal, which I'm sure most of us all are very aware of, may finally be moving into the rear view mirror for now. But regardless of market dynamics, up or down, I thought I could take us through some of what we believe are the most important principles in structuring insurance for affluent families and family enterprises. First is buy insurance for catastrophe, not convenience. Insurance works best over the long term when it's used to protect against large, low-frequency events that could materially impact net worth. So an efficient approach to risk transfer generally includes three things. First is, quite simply, carry higher deductibles. A $10,000, $25,000, $50,000 homeowner deductible can easily be justified for larger homes. Second, reserve insurance for events that materially affect financial outcomes, such as major liability events or catastrophic property losses. Do not file claims that are immaterially higher than your deductible. And third, self-insure predictable or affordable losses that can reasonably be absorbed, such as routine roof maintenance, landscape damage, or minor interior water intrusion cleanup. Next is carry sufficient liability limits, sufficient in quotes. Unlike property risks, which the exposure is generally capped by the value of the asset, liability exposure is effectively uncapped. A severe injury claim, wrongful death case, or reputationally charged lawsuit can result in damages that extend well beyond what most people intuitively expect. One of the major reasons this has become increasingly important is the rise of what are known as nuclear verdicts, generally defined as a liability award exceeding $10 million. And these verdicts have increased dramatically over the past decade. In some categories of litigation, average awards are now measured in tens or even hundreds of millions of dollars. The result is that liability limits that may have seemed sufficient a decade ago can now be much less protective than they once were. The practical risks that we all have with respect to personal liability is the fact that we operate a motor vehicle, for those of us that drive. This is the most likely reason that we'll find ourselves being allegedly or being accused of being negligent for causing someone else's injury via an at-fault vehicular accident. Personal excess liability is designed to protect against this type of situation and many others. And we believe the minimum limits that a high net worth individual should purchase is $5 million. And for an ultra high net worth individual, it should be $10 million or above. Additional best practice relates to property valuations. One of the most common misunderstandings in property insurance is the difference between market value and replacement cost. Insurance is designed to pay the cost to rebuild the structure, not the price the property might sell for in a real estate market. In many locations, especially high-value urban or coastal areas, construction costs can be significantly higher than average. Because construction costs change over time, it's important to periodically confirm that insured values reflect current rebuilding costs. In fact, some policies include what's called an 80% or what's called a co-insurance clause, and that's typically set at 80%. And what this means is the property must be insured at the time of the loss to at least 80% of its replacement cost to avoid a potential penalty at the time of the claim. Note that high net worth insurance carriers generally offer guaranteed replacement cost, meaning that co-insurance requirements are not applicable with these types of carriers. Regardless, it's a good practice to review and update property valuations every 3 to 5 years, or sooner if there have been major renovations or significant changes in construction costs. And let me begin to kind of close with a few additional best practices that additionally make the biggest difference in how well an insurance program actually performs. First is, we talked a little bit about this, is, be aware of where coverage gaps can exist. So understanding what the policy exclusions and sublimits are and where excess or surplus lines markets may apply. Never assume policies automatically line up. Secondly, stay aware of emerging risks. Cyber risk and cyber coverage continues to evolve quickly, and this should be reviewed at least annually. Also, the legal environment is becoming more aggressive, particularly with liability litigation, driving the need, as we discussed, to consider higher liability limits. Third is to be strategic about when to use insurance. Claims should generally be reserved for large, meaningful losses. Fourth, make sure insurance aligns with legal ownership structures, whether properties or assets are held in trusts, LLCs, or other entities. The named insured structure needs to match. Fifth, risk controls matter more than ever. Carriers are increasingly rewarding prevention, which includes things like water detection systems, wildfire mitigation, cybersecurity protocols, and other protective measures are favorably received by underwriters. Sixth, as risks become more complex, specialized expertise becomes more important, especially when navigating the excess and surplus lines markets where policy language can vary widely. Seventh, review your program annually, but don't necessarily shop annually. And finally, work with an advisor, not just a transactional agent. Because insurance isn't just about buying a policy, it's about making sure the protection actually works when it's needed. So I've tried to kind of touch on a lot of topics here. And just to give you all a flavor of the different angles that need to be addressed with a family enterprise, family office, ultra high net worth family. So to bring everything together, our suggestion is when you think about enterprise risk management in your family enterprise or family office, you're thinking about something that's really unique. Family offices in particular often manage very large and complex enterprises, but they frequently operate with the staffing and infrastructure of a small business. That mismatch can create gray zones if risk management isn't approached intentionally. It's also important to remember that insurance itself is not the strategy. It's simply one tool, as we discussed, within a broader risk management framework. Family enterprises present additional complexity because they blend personal and commercial exposures, and in many ways, the family itself becomes the enterprise. And because of that, family risk cannot be separated from enterprise risk. Lifestyle, governance, assets, and business interests all influence one another. So when risk management is done well, insurance becomes the final layer of protection. And this is after thoughtful planning, proper structures, and proactive controls are in place. Ultimately, the goal is not simply to buy insurance. The goal is to protect the continuity of the family enterprise across generations. And we are available for discussions on these topics or any others that relate to family enterprise risk and ultra high net worth families. My contact information is here, and I've got my LinkedIn QR code. Feel free to use for any need, no matter big or small. I really appreciate your time today, and I'll stop sharing, and Ebo, I'll kick it back to you.
Thank you, Jeff. I appreciate it.